Here we go. 2006, Duffy's go out and they buy a residence. 2 million bucks. First number we got to remember, 2 million bucks. It was meant to be a second residence. At least that's what they said. They bought this thing with a $1.4 million mortgage. Now, what did we talk about way back in Borderline, right? Mortgages have different characters. Are they non-recourse? Are they recourse? And we'll talk a little bit later about exactly the differences between the two, but this particular mortgage was non-recourse. Non-recourse, again, meaning that if the borrower doesn't pay, right, the Duffys, the only thing the lender can do is seize that property and sell it. And if it ends up being worth a whole lot less than the road, now they lose, not the borrower, okay? So it's a non-recourse mortgage, 1.4 million. Now, they bought a house for 2 million in 2006. If we remember back, probably not the best time to buy a house for 2 million bucks, because as soon as that happened, right, values started to plummet around the country.
Right.
And so 2009, 2010, what do? They start renting the property. And I'll give everybody one guess why they started to rent that property, but it's the first issue that we're going to have to address. 2011, they sell that house they just bought in 2006 for 2 million bucks for $800,000. Right? So they take a beating. At the time they sell it, they had a $1.4 million mortgage, started at 1.4, so they didn't pay any of the principal off, and they owed 110,000 of interest, right, that they hadn't paid yet. Okay, so what happens? You you owe a bank 1.4 million. You sell a property you bought for 800,000. You turn over the $800,000 to the bank, and the bank says, "Well, we can't come after you for the remaining 600,000 because it was a non-recourse mortgage, so you're off the hook for that 600,000." So what do the Duffys do, right? Well, first they look at it to what to them is logically, and they say, "We bought a house for 2 mil, we sold it for 800,000. We'll take a $1.2 million loss." Then they say, "Well, we owed the bank 1.4, we only paid them 800K. We'll recognize $600,000 of what we call cancellation of debt income under Section 61A11. So the net result is they take a $600,000 loss. Okay.
All right.
All right. So facts have been laid out. Okay. Now, where do we go from here? The IRS comes in and says, this whole $1.2 million loss, we're denying the whole thing. And I'll explain why in a couple of seconds, right? This $600,000 of cancellation of debt income you picked up, that's not enough. You had $110,000 of unpaid interest on this loan, and you got to pick up that amount as cancellation of debt either. Now we're going to see that's low-hanging fruit, silly mistake by the IRS. It's the second time I've seen them make that silly mistake in the last 3 years. I don't know why they do it, but we'll talk about that here in a couple minutes. So who's right? Who's wrong? Why is this my favorite case of the year? All right. Let's start out with a very simple, kind of the chronological order in which this whole thing unfolded. So they bought this house for $2 million in 2006, right? In 2009, 2010, they start renting the property to family and acquaintances, right? I don't remember if I said that or not.
I didn't quite mention it, but yeah, no, that's a key fact there. Okay, we'll add that to our numbers. All right.
So they start renting it to family. But interestingly, they took depreciation on the return for the rental, but no other rental expenses whatsoever, okay? And then in 2011, they dumped this thing for $800,000, recognize a $1.2 million loss. What are the problems with that loss? Why did the IRS deny it? Such a simple thing that we as practitioners can avoid, okay? They bought a house for $2 million. They started renting it 2 years later. Why did they start renting it? Everyone, should know why. They started renting it because that thing was losing value like you couldn't imagine. And if you sell a residence, right, a residence that's not rented, if you sell it for a loss, can you deduct that loss? No. Under Section 262, it's a personal loss, right? So you dump your house for less than you paid for it. Hey, That's on you. You can't take the loss. So when somebody owns a second home, we all experienced this, a decade ago. Someone owns a second home that starts bleeding value. What do? They try to convert it to a rental, or at least pretend they're trying to convert it to a rental, whatever it may be. Because the thought is, if you convert it to a rental, it's not a personal asset anymore. And if I go ahead and sell it for a loss, now I can take the loss. And the funny thing is, right, to a degree, that is correct, except obviously the IRS is going to build in safeguards, right? What are those safeguards? The safeguard is, if I buy a house for $2 million and I convert it to a rental, they're going to make sure that any loss I eventually claim on that house does not include the drop in value that happened before I converted it to a rental. So under the regs at 165-9, they say on the day you convert, right, a residence to a rental, your basis in that residence for the purposes of computing future loss is the lower of what you paid for it or what the fair market value is on the day you convert. So if I buy a house for $2 million and on the day I convert it to a rental, it's only worth $1 million, and then I sell it for $800,000, I can take a loss, but only $200,000 of loss. I can't take the $1 million that happened when it was sitting unoccupied. And so here, usually the issue we have around the industry is like, hey, clients, you want to show you converted this to a rental, you better really rent this thing out, right? Make every effort you can, advertise it, get some tenants in there, and I'd feel a lot better if you actually rented it for a while before you sold it. Now, in this case, boy, I mean, the IRS just came in and said, we don't care. We don't care if you really did rent it. And the reason why we don't care is you can't prove to us what the value was in 2010 and 11 when you started renting this thing out. And so you bought it for $2 million. We know you sold it for $800,000. But if you can't tell us what the value was on the day you converted into a rental, then we can't possibly know what amount of the loss is allowable to you. Because, hey, maybe this thing was only worth $800,000 when you put it in as a rental. So you didn't actually lose any value. And so I don't get it. Like, I don't get why they couldn't find some way to back into the value at that time, like comps around the neighborhood or something like that. Right. But long story short, they lost a $1.2 million loss because they could not substantiate what the value was at the time the property was placed in service. So obviously the lesson to our industry is, if values are dropping and people want to convert, we have to explain to them that we need to know the value today, because that's going to fix our value for depreciation purposes. That's going to fix our value for future loss purposes. So these people lost a $1.2 million loss because they just didn't bother to come up with the value. If they had come up with a value of whatever it may have been, 1.5 million at the time of the transfer, or at the time of the conversion, they may have been entitled to some degree of loss. But that takes us to the next point that I love about this case. What would the loss have been? What would the gain have been, right? And what we're getting at here is, okay, so the IRS comes in and says, $1.2 million loss, gone, can't take it. But remember, there was another component to this sale. They sold this property for $800,000. They owed the bank 1.4, and so the taxpayer picked up $600,000 of cancellation of debt income. So let's talk about cancellation of debt income for a couple seconds here, right? I loaned Damien $500. You might feel $500 richer, but you're not, right? You owe me that $500 back, presumably.
Right.
But if I come to you tomorrow and say, you know what, Damien, keep the $500, it's yours. Then under cases, like Glenshaw Glass and eventually, Kirby Lumber, you've been enriched. You got $500 that you can pocket now. You don't owe it back to anybody. And so they eventually codified in section 61A11 that, hey, the minute I tell you, Damien, you don't owe me that $500 back, you've got taxable income, right? $500, okay? So we have this concept of cancellation of debt, but holy cow, is cancellation of debt more often than not screwed up in the context when someone, we saw this all the time in the 2008 to 2012 era, when someone sells a house or a rental property, whatever it may be, in a foreclosure or short sale where the property is sold for less than what they owed on the debt. And here's why. And if you take nothing else away from this case, I hope you take this away from it. If someone comes to you and says, hey, I sold my house for $800,000, but I owed the bank 1.4 million, what are the tax consequences? You cannot answer that question until you first ask a question of your own. Was that mortgage non-recourse or was it recourse? Because the law has developed to treat the two scenarios very, very differently. Okay? Why? All right. Stick with me here. All right. What is a non-recourse mortgage? What is a recourse mortgage? We've already defined non-recourse quite a bit. Bank loans you money to buy a house, and the deal is if you don't pay the bank back, their only option is to take the property and sell it. And if it's worth less than what you owe the bank loses. So the bank bears the risk of loss for a non-recourse debt. If you sell the property at auction and turn over the proceeds to the bank, you have washed your hands of that obligation. Nobody can chase after you for anything more. Okay? Now you might say, well, nobody's going to loan on a non-recourse basis. But the thing is, for a lot of residences under state law, they're called anti-deficiency states. We got a number of them around the country. Doesn't matter what the loan agreement says. Under state law, the only option the lender has is to seize the property and sell it. So that's a non-recourse mortgage. This isn't rocket science, right? So a recourse mortgage is the exact opposite. In a recourse mortgage, not only, if the loan is 1.4 million and the property sold for 800,000, not only can the lender pocket the 800,000, they can bang on your door and say, pay me my remaining 600,000 as well. And so in a recourse mortgage setting, you, the borrower, bear the risk of loss if the property value goes down, because you got to come up with the extra cash now. So taking those two fundamental concepts, we can start to understand why the law developed differently for each one and why you can't determine the consequences until you know what the loan is. If it's a non-recourse mortgage, right, the critical case is a Supreme Court case called Tufts that, believe it or not, it's not that old. It's 1983. But in Tufts, right, what they established here is that if a mortgage is non-recourse, well, then when you sell the property subject to that debt, as I said before, and this is the nice thing about having video, Damien, you can see kind of my, that I'm driving home a point here.
Exactly. You have, I know. All right. I'm ready. I'm like, okay, he's about to land the plane here. He's gonna drop the hammer.
You have washed your hands of that debt. And so you're no longer on the hook for it. And so we have a principle under the section 1001 and 1011 regs that if you own property subject to a mortgage and you sell that property and your responsibility under that mortgage is extinguished, that debt extinguishment is part of your sales price. And so here we end up with a very counterintuitive rule where if you sell property subject to a non-recourse mortgage or have, again, non-recourse mortgage forgiven, I should say, the mortgage is treated as your sales price. And what's so critical about Tufts is Tufts was the first case that made clear that it's treated as your sales price even if the mortgage is significantly greater than the fair market value of the property. So think about our facts again. Property was purchased for $2 million and the mortgage was $1.4 million and it was sold for $800,000, right? So this is a personal residence, so it's not going to matter because a loss is a loss is a loss. It's not going to be deductible, but it does kind of matter because in a non-recourse setting, even though this thing was sold for $800,000 cash, when they report it for tax purposes, the purchase price would actually be the full balance of the debt, $1.4 million. And why is that critically important in the case of Duffy here? Because think about it. If you have a non-recourse mortgage that's all included in your sales price, you cannot, by definition, have cancellation of debt income because there is no forgiveness element. And there's no forgiveness element because how can the bank forgive a debt they were never entitled to collect on in the first place, right? The only option the bank had was take that $800,000 and apply it to the 1.4 million, and they lose the other 600,000. So they can't forgive a debt, that they didn't have the right to collect. And so think about this. What if this hadn't been a principal residence? What if it were a rental property that had been depreciated down to $1 million, and then they sell it for 800,000 and they have $1.4 million of debt they have to pay off? Well, what would probably happen is they record a $200,000 loss on the sale of the property and then $600,000 of cancellation of debt income. But what we haven't talked about yet is cancellation of debt income is great because there's a host of exclusions, right? Exceptions to cancellation of debt income under 108. If you're insolvent, if you're bankrupt. And so they might have gotten the best of both worlds, a $200,000 loss and $600,000 of COD that could be wiped out by an exclusion. But if it is a non-recourse debt and the basis is $1 million, you sell it for 800,000 and the loan is 1.4, sorry, you don't have a $200,000 loss. You've got 400,000 of gain because the property is deemed to be sold for the full balance of the non-recourse mortgage. Now, okay, we'll talk about how this applies to Duffy, but in a recourse mortgage setting, then you want to flip over to what they call the Aizawa case, AIZAWA. And Aizawa is very logical as well. It says, wait a minute, if it's a recourse mortgage, when you sell the property, you have not, and here's the visual again, you have not washed your hands of that debt because the bank can come after you for the excess. So you owed the bank 1.4, they only pocketed 800,000, they can bang on your door for the extra 600. And so in a recourse mortgage, when you sell a property, it's bifurcated into two transactions. First, you're treated as having sold it for its fair market value. And then if the excess debt is forgiven, you recognize cancellation of debt income. Okay, so why does this matter to Duffy? Because for Duffy, if the loan is non-recourse, then they're treated as having sold that property for 1.4 million, and you cannot, by definition, have any cancellation of debt income. And if it's a recourse mortgage, then they're treated as having sold it for 800,000. They could have $600,000 of cancellation debt income that they could, potentially apply one of the 108 exceptions to. And so the Duffys had picked up $600,000 of income. They hadn't used an exception. And this ends up working in their favor because they say, hey, under state law, your particular mortgage here is non-recourse. And because it's non-recourse, you are treated as having sold it for 1.4 million. All that does is shrink what is already a non-deductible loss, and we denied your loss anyway, but it means that you cannot, by definition, have $600,000 of income, of cancellation of debt income, because there is no COD. It was a non-recourse mortgage. So they lose the $1.2 million loss, but at least they also don't have to deal with the $600,000 of cancellation of debt income. Last element. Okay, if they had to pick up $600,000 of income, right? There are exceptions to that under Section 108. And as I explained, under 108A1A, if it's debts discharged in Chapter 11 bankruptcy, right, you don't have to pick up the income. If you're technically insolvent, meaning the debts exceed the value of your assets, then you can exclude it to the extent of the insolvency. If it's a principal residence, you can exclude it at least until the end of this year, up to $2 million if it's on your principal residence. But where 108 comes into play under the Duffy case is actually in a couple different realms. And one of which we hadn't talked about, I'm just going to tack on the end. One of which we did talk about. The one we talked about that I said was low-hanging fruit is when the $600,000 of debt was forgiven, they also owed, the extra $600,000. It was a $1.4 million mortgage. They owed $110,000 of interest.
That's right.
And that interest was forgiven. And the IRS said, you got to pick up COD income for that as well. But reason I call this low-hanging fruit is make sure you're aware under section 108E2, you never have cancellation of debt when the debt that's forgiven, right, would have been deductible had you paid it. And so mortgage interest, right, 163H gives us a deduction. And so this was a silly argument by the IRS. And it's the second time, like I said, they made it in 3 years, right? You don't have COD income when mortgage interest is forgiven because that mortgage interest would be deductible. And so they just kind of tossed that one out. And then the last thing I'll say on Duffy, we didn't discuss this because it's a smaller piece, but they had it on their principal residence. They had taken out a $400,000 loan that was also forgiven during the year. And they picked up the cancellation of debt income, but then they argued it was excludable as a principal residence indebtedness under section 108A1E. And as I mentioned before, A1E was actually added to the law when things went bad in 2006. And it says, hey, lender forgives a debt on your principal residence. You can exclude up to $2 million. And that's important because that provision expires in 13 days. And so hopefully people get their debt forgiveness if they're still haggling for it before the end of the year. But the key there is, right, every word in the law is so important. To be excluded as principal residence debt, the debt has to meet the definition of 163H. 163H talks about acquisition debt or home equity debt being deductible if it was used to what? Acquire, construct, or improve the house. This was a home equity line that had been used for personal expenses. So even though it was secured by the principal residence and they thought it was principal residence debt, it wasn't because it wasn't used to acquire, construct, or improve the house. So they couldn't use 108A1E. But again, why this is my favorite case of the year, they then said, but you know what? It looks like you were insolvent during the year. And so the case actually walks through the insolvency exception and how they computed insolvency for an individual. It would not translate well to podcast world, but for anybody that's looking for an understanding of how one computes the value of assets and the amount of liabilities for an individual, that's what, again, makes this Duffy case so great this year. I mean, we just traversed 165-9, Crane, Tufts, Azawa, the 1011 regs, 1001 regs, 108A1E, 108E2, and 108A1B in one case. That's pretty good bang for your buck right there, Mr. Martin.